Hello traders, this is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. In this video, I will break down limit and stop orders. At times, traders find the market trend, but have difficulties getting into it. Entering the market using limit and stop orders can be helpful, especially for swing traders. Stay tuned. Leave the indicators alone. This will be a three-step process, starting with core curriculum, chart activity, and lesson plan. Let's jump right into our core curriculum. In order to comprehend this entry ideology, we must talk about counter-trend candles. A counter-trend candle is when the market is trending in one direction and prints an opposite candle to the trend. Let's take a look at some examples. Here is an example of a bullish month. This is US dollar versus Japanese yen, February 2023. Granted, this is hindsight, but if you had to go back in time and catch this uptrend, how would you execute trades with the least effort? Well, I tell you, I would wait for the down days to print and buy after them. We can see there's 8 down close days, and for the most part, buying occurred right after these down days. These down days are counter trend candles. Since the market is trending up, any candle that is down is opposite to the trend. That is where new buying is most likely occurring. Looking at this example here, for February UJ, price is going up, but anytime we get any down close candle, and which we're considering counter trend candles, we normally saw buying occur right after that daily candle posted down. Here is an example of a bearish month. This is British pound versus US dollar, August 2022. As I asked before, how would you have caught this trend if you had the chance to go back and trade this month? As you can see, it's clearly trending down for this month. Well, I would simply tell you, I would wait for all the up close days to catch the sells. Right after these up close days, we see price followed by selling. These up close days in this downtrend is going to be considered a counter trend candle. For this month, we can see 7 up days, which are all counter trend candles. Step 1, open up the daily chart and mark out the trending leg in price action. Step 2, mark out all counter trend candles. Step 3, enter on the close or open of the counter trend candles with stop or limit orders. Let's take a look at what that looks like. Buying with limit orders. Now the market condition needs to be bullish. Let's say you've done your technical analysis, your fundamental analysis, you looked into your macros, you've done everything in your power to come to a sentiment that the market is bullish. Let's just say for this reference that the market is targeting a higher time frame premium array. It's going to trend up and target and draw towards this premium array. What you're going to do is wait for a down day and set a buy limit order at the close of the down day. Now on the right, we have a bar, and let's say that bar represents 1 day. This 1 day had closed down, and you know that you're in a bullish trend. This may be an opportunity for you to go long. How would you get into the market long after a down day? With a limit order, you would simply place the limit order at the close of that down day. Now this is how you buy on weakness. You're telling yourself that when the next daily candle opens, it's most likely going to drop down and inject you into the market long because you have a limit to go long at the close. Now, the same thing can be said vice versa for stop orders. So buying with stop orders when the condition is bullish, you're going to wait for a down day and set a buy stop order at the open of the down day. So it's vice versa. That means you're going to be buying on strength. So since you're placing a buy stop, price is running up and going to knock you in, it's based off of strength. The market is going up. So the next daily candle after the trend is bullish and you got a down day and you want to place a buy stop order to get into the trend after a down day, you place it at the open of that down close candle. That's where the market is going to knock you in with strength. Let's look at an example and how this could be utilized. For this example, we're looking at US dollar versus Japanese yen, February 2023. And as we can see, this clearly was a bullish trend or bullish leg or a bullish month or whatever you want to call it. Yes, it is hindsight. However, I tell traders this all the time. Hindsight creates exposure. Exposure creates experience for future price action. You're using hindsight to help you gauge what you could potentially see in the near future and tell yourself, hey, I've seen this before. I know the conditions. I know the characteristics. I know what I should be doing to execute to take advantage of what is unfolding in front of me. So let's say you've came to the sentiment that market is bullish. Now, many people may ask me in the comments, how do you know bias? How do you do this? I have a video on how to find bias. I'll leave it in the bio for you, but this video is solely on entry techniques. Once you come to the conclusion that you're bullish, this is what you're going to do. You're going to wait for every down day, and you're most likely going to either get in with a limit order or a stop order. You could do both, but I suggest you pick one because it will reduce the amount of risk you take. Now, if you were to start at the beginning of this month and tell yourself you're going to be a buyer, the first day is down, which is great. What are you going to do? You're going to set a limit order here. So to type it in, limit order. You're looking to go long on weakness, meaning the next daily candle shall open, drop down, and trigger you into the market long. That's what's going to happen. The market's going to open, drop down, trigger you long. That's what we're anticipating to occur here. Now, let's see what happens the next trading day. So we'll play it forward one day. As you can see, you would be in drawdown. However, you would have a risk parameters, and we'll talk about that towards the end. But as of right now, you would be in drawdown. Let's say you got another down day. Okay, let's just buy at the close once again. And we'll just copy this. Let's buy at the close of that down close candle. What happens the next day? You can see you're triggered into the market long on weakness, and price takes off. Price runs all the way up to the upside. Now, if you were to do it from the other opposite end, and also to buy at the open of the down close candles with a stop order, so stop order. So you're buying with what? Buying with strength, because the market is going up and it's going to trigger you into the market on strength. You would be in profit with this entry technique, and you'd be in profit with this one as well. You're not going to see it because the lines are going to overlap. But let's say you were to get in long right here as well, with that stop order here. You would be long on both ends, on strength and weakness. Now, it's totally up to you if you want to do both, but like I said, I prefer you to take one, and that one I would suggest is probably the limit order. I rather buy when the market goes down because it's cheaper, rather than to buy when the market is going up. I want to buy on weakness. To me, that logically makes more sense. Now, if we were to play this forward, right, we'll take all this off, and hopefully you're following me here. This is how I'm using the market for my swing trades generally. Play it forward, we can see, okay, it's another up day, but we're still long. Let's say we're still hypothetically long because we brought here and we brought here. I'm going to show all the parts we could have brought, and we brought here. Don't forget there's another buy here. Not this down close candle close, but this down close candle's open. The two lines would be stacked on top of each other. I'll just put another line there and then just make it a different color. There you go. So you got two longs here, a long here, a long here. Let's play it forward again. We got a down close day. What should we do? We should seek to buy at the close of that candle with a limit order. And if you don't want to do that and you would prefer to wait for price to get back up here, you could get in with a stop order. Let's see what happens the next trading day. So you're in the market long right here. You're still in the market long, still holding, and you're still holding. And you can see price gets up. Eventually, you're in profit from this candle here. You do have another down close candle, and the cycle can repeat again. You want to go long, you go long here. You want to go long, you go long at the open with a stop or a limit order. And you can see how the market triggers you in long here as well. You're in long there. Play it forward, see the market still going up. You're in a bullish trend. Notice every time we get a down close candle, it almost seems as if the market's going to fail or break down. That's what retail is thinking. Retail sees the down close days and they think, oh, it's the end of the world. Market is just going to continue to collapse and trend lower. That's not the case here. If the market is going to trend higher, whenever you get those down close days, they're just counter trend opportunities where the commercials are repositioning themselves to go long. They're increasing their net long positions in these down close candles, which is why you see the next day the result of that. Price is running up. Down close candle again. What can we suspect? Maybe buying, right? Let's say we still have the idea. We haven't meet our target of TP or pips, whatever it is. Look at that. You would be in long. Profit. Down close days again. It's the same thing. It repeats itself over and over and over again until price eventually gets to where it wants to get to. Its desired premium range, since it's going up from a cheap point all the way up into an expensive point. So those are all opportunities to all get in long. And that's how you would play that out on a bullish bias or bullish sentiment. And you're able to hold these trades longer if you have a higher time frame objective. There's a higher time frame PD array that is suspected to be the draw on price, whether that is a bearish breaker, a bearish order block, a volume imbalance, a gap, anything of that nature, an old low, an old high, and you suspect price to go higher, you wait for the down days. And as you can see, it's very powerful when you look at it this way. You don't even need intraday. Many people ask me, how do you trade without intraday? Just like this. Now, there could be some blending of other tools, of course. Now, many people know you can incorporate swing highs, swing lows, other PD arrays that you see in the price action. But if you were to look at it from a very simple standpoint, buy after a down day. And that's the end of the month. So that's one bullish example. Let's take a look at gold. And we're going to find a leg that's trending up. Let's just find any month. That's my recent IPTA stuff. Let's find a leg price action where it's trending up. Look at March. This is a good example. This is March, and this is all the way up to April. Look at all the down days here. Opportunity, opportunity, opportunity. 3 days to potentially go long. One, down day, buy. Down day, buy. Very dynamic here as well. So there's a confluence here. Many people know what I'm going to be referring to here. Shout out to Larry Williams. Small range day, large range day the next day. Really dynamic. It's small and it's a counter trend candle. It's down. So you have an opportunity to go along here. Let's just talk about the stops. Let's say and vice versa now. If you want to buy at the highs here, right? You rather have price come back up. You're triggered in long here. See that? You're triggered in long here. You're buying with a buy stop here at the high. Sorry, at the open. Not the high, the open. The open of the down close candle is where you're putting the buy stop. Price triggers you in long here, you're in profit. Another day, profit. So just mark that off as a buy stop order. So that's what's occurring there. And you see the same thing is occurring over and over again after these down close days. You're in long here on strength. Market is running up into your order. Same thing here. You're in on strength. Nothing changes here. Now, many people may ask, what about you get 2 down days? That could be 2 opportunities. Let's say you get 3 down days. Those are 3 opportunities for you to go long. And towards the end of the video, we're going to talk about the risk parameters that you should be taking. But it still stands that if you get the down day, it's just another opportunity for you as a small speculator to get an opportunity to take the chance of price going higher, because you know that your technical and fundamental is leading you towards the analysis of being bullish. And you buy at the high at that, market triggers you in long there, market triggers you in long here when it comes up, long, same thing here. It repeats itself. And as you can see, eventually it gets above. Yeah, there's some drawdown here. But you can see that if you were to get into the market here, you're in long, it came back down and put you in drawdown. But over time, you see that back into profit. That's how I would gauge that there. You're right back into profit. But that's how I'm utilizing my knowledge of finding bias, using IPTA, and then using this technique to get into the market long, I don't have to scale down to the lower time frame if I don't want to. This is definitely more preferred for a swing trader or position trader. It is the easiest way for you to get into market without stressing yourself. I promise you. Inversely, the same thing can be said when using limit or stop orders. When selling with a limit order, the market condition should be bearish. So you've come to a higher time frame analysis that the market is going to trend lower. It's going to draw down to some type of discount array. You're going to wait for an up day and set a sell limit order at the close of the up day. This is how you sell on strength. So you're placing a sell limit at the close of the up close candle. You can see it's depicted here on the right for you guys. Price is going to most likely the next following day after you get an up close printed day, closes off. You're anticipating that the next daily candle is going to run up and then sell short. So you're trying to get into the market on strength there, selling on strength. Same thing can be said vice versa for the sell stops. So selling with a sell stop order, you're going to wait for the market condition to be bearish, of course. You're going to wait for up close day and set a sell stop order at the open of the up close. So the open of the up close, selling there, is when you sell on weakness, meaning the market is coming down, you're selling on weakness. So you can see here on the right, it's depicted. The open of the candle is where you would place the sell stop. You're placing your sell stop order right there. The next daily candle should post and go down and trigger you into the market short. Let's take a look at some examples. For this example, we're looking at British pound versus the US dollar. And like I said, this is hindsight. Hindsight, it's only going to expose you to gain more experience. What you're experiencing here is a bearish leg and how to get into the market short if you ever come across the sentiment being bearish. You can see anytime we got an up close day, the market was met with selling. You can see here, after this up close day, there was selling. After this up close day, there was selling. After this up close day, there was a selling opportunity. Here as well, here as well, here as well, and here as well. Now, how would you get into this market short? Like we said before, let's say we come back to the start of the month and we said, we know that British pound is going to go lower. What should you do? You would either enter the market on strength using a limit order. So you place the limit order here. So the market is running up and it's going to trigger you in short. So you're expecting the next daily candle to open, run up potentially, and then go down. That's what you're anticipating here. Same thing can be said vice versa on the opposite end if you're going to go short on weakness. So price is going to go up and come down and is going to trigger you into the market with a stop order. You're going to place a stop order right at the open of the up close candle. So you have two opportunities potentially to get in short, on strength or on weakness. Two opportunities there. The fact that you have two opportunities gives you more opportunities to say, I can compound within the next daily candle. And you can take advantage of the marketplace. You can take more of the marketplace. So let's see what happens the next trading day. So we'll just move this over. You play this forward once. And you can see the market opened here with this candle. So it opened here around the limit order, triggered you in short on strength with the limit order, and then it came down and triggered you on weakness with your stop order. You play it forward, see what happens. You can see you would have 2 days of profit currently. And like I said, we'll talk about the stop loss and TP parameters at the end. Another up close day. What should you do here? You'll follow the same ideology. Limit order here, stop order here. What happens the next day? Let's see. Down. Next day, same thing follows. I see the chart is getting a little messy, so I just want to clean it up. We got another up day. What do? You go short here or you go short here. You can't not be looking to place these limit or stop orders while this candle is still pending. You need to wait for it to finish. Then you go in, open up your MT4 or whatever platform that you use, your laptop. Then you go in and place your orders and you set your parameters up. You cannot be setting up the parameters while the candle is still forming. It's not possible. Play it forward. You can see there, we're in short here and we're short here. So you're in on the market on both sides, strength and weakness once again. Price goes up. Now you're in some drawdown, and it's okay. Like I said, it's a swing setup. So you're most likely going to endure this, depending on your equity and the basket of risks that you want to take. But the same thing follows suit. This is just another opportunity to go short. Let's see what happens the next trading day. We're in the market now short. We don't get back down here yet, but we can see we are definitely in the market short with that limit order. That limit, that sell limit, price runs up, you're in the market short. You go another day, you can see prices continue to get down. Hasn't gotten down here yet here. So this stop order is not triggered yet because it didn't get there, but you're still short in from the limit. You play it forward again. You see there, you're in profit from this. Now you're in profit and you triggered yourself in on weakness. And the same thing occurs. Look at what happens after all these up days. Look at this, another one. It's like taking candy from a baby, especially when you know the trend. Once you figure out the trend, you wait for the counter days. Look at that, another one here. Now, does that mean you have to hold these trades for 3 weeks, 2 weeks, 1 week, a couple days? No, you could just be holding it for intraday scalp opportunity just to get into the market quick and take some profit off without having to scale down to the lower time frame. There's no need for it. Unless you really want to reduce your risk and you're not a swing trader at heart and you want to find a lower time frame entry, you can do that and use another model. But this is for people that may not have much time. And there is. All these are opportunities. Every single one is an opportunity. I hope we all can see that. These are all opportunities to go short. Now you start to see the power of swing trading and how you're able to potentially maximize your profits and catch more of a bulk portion range. I'm not trying to catch a little range. Me personally, I'm not trying to catch this. I'm trying to catch at least half of this. That's what I like to do. Or even the whole thing. It would be nice to try to catch the whole thing. Of course, you're going to scale out. You're going to take partials here. You're going to trail your stop. Things are going to occur like that. Let's take a look at another example. So let's just take a look at, let's look at something completely different that I normally don't look at. Let's look at like CAD JPY. Completely something I don't even look at. Let's just find a bearish leg. Doesn't matter where it is. We're going to find a bearish leg. We're going to come to a point. We have a bearish leg. We're going to remove all this stuff. Okay, so we got November. November is showing a good sign that it was a bearish month going into December. Doesn't matter the pair. Doesn't matter the asset class. Look at where all the the up close candles are. And look what happens immediately right after them. Shorts. The market clearly on the higher time frame was trending lower. It was looking to draw to something lower to the discount array. Whether that's a bearish order block, bearish breaker, gap, fair value gap, etc., etc. Volume balance, the list goes on. Go short here on the limit, go short here on the stop. And you can see, look at the reward for that. Look at the reward. That is really nice. Like I said, this would be the limit. This is the limit order. And this is the stop order. There you go. You're in on strength and then you're in on weakness. That's how you're utilizing this one candle. That's how you would utilize the counter trend candle. Same thing here. here to here. You're in long here. More opportunities here. I don't have to draw every single one out, but it's more opportunities here for you to find shorts. In these up close candles, what are the commercials doing? They're increasing their net shorts. Instead, the retail traders, the majority of the speculators, they're thinking to themselves, oh, it's an up close day, so most likely the market's going to trend up tomorrow. That's not the case. We can clearly see that's not the case. The trend is down, and we can see, granted with hindsight, after the up close candle and the market trend was lower, there was selling occurring after the up closes. See how powerful this is? Very powerful and very simple. Love the simplicity here. Here, it doesn't take me too much time. I don't have to be a slave to the chart. I don't have to sit in front of my screen for hours at a time trying to guess what bullish order block or what fair value gap I'm going to take. I can simply just place the order here and here, call it a day, hold for lower price action. You can see here as well, another small range day, and it's counter trend. Shout out to Larry Williams. Look at our price right there. Goes lower. Small range, dynamic large range the next day. Here and here. Right? Going into the last day. Going right into December. You got that short. You can see how it's very simple to get into the market with limit and stop orders. Once you've done your homework and understood where the trend is going to go and where it's most likely going to draw to, it is cake. The main takeaway from this video is, first, find the trend or draw on price. Without this entry technique is not feasible for you. You're going to waste your time. You're going to feel like the market is against you. You can't pick any random up day or any random down day then to consider it a counter trend day. There needs to be some type of analysis before using this entry technique. Find the draw and then execute. You may not get it right, but eventually you'll see with experience, you're going to start understanding how to find the trend and how to get into the market without using any lower time frame entry techniques or missing out on a move or spending hours at a time at a chart. This entry technique is mainly for people that are swing traders. They don't have enough time and they have other dependents like kids, a spouse, husband, wife, etc. You know, they're taking care of their grandparents, whatever it is. They have something else that keeps them away from the chart, which is normally better. The less time you spend on the chart, the better it is. That's my personal experience. If I had to go back and tell my younger self another thing, take time away from the chart and live life. Find models that can excuse yourself from having to slave away and hurt your eyes, staring at a chart all day, staring at the phone all day. Life will pass you by. It's more than just the charts. I want you guys to understand that it's bigger than trading. It's always bigger than trading. Trading is not what makes you. Money does not make you. Understand that. Second, find your target and stop loss. So what's your TP? What do you think the market is most likely going to get to? And what's the amount of risk you want to take? And we're going to talk about that with a couple of examples. And you're going to risk properly for each trade, of course. So let's just jump into some examples and how I would set it up and how I would go about it during a swing trade. For example, we're looking at British pound versus US dollar. And I think this is a great example because I already tracked GU for the month of March. So if you look in my channel for the playlist 2023 tracking and you look for the month of March, you see I tracked GU and you see exactly what I'm talking about here and how I was able to find these longs. If price breaks a swing high formation, that is going to be, in my idea, a bullish momentum shift right here. So that might be the market turning into a new trend or a false break. In order for it to continue to trend higher, I just want to see a higher swing low after breaking a swing high. So swing high broken, we want to see a higher swing low form. The most recent swing low that we have is right here. Let's see if we get a higher swing low going forward. And as I know, we do because I tracked this and I was able to catch the longs. But that's your higher swing low formation here. Let's play it out one more candle. Higher swing low formation here. Once we get that higher swing low, you have more confidence that the market makers are most likely buying GU. It's going up. British pound is gaining strength and dollar is getting weak. At this point, if you think it's going to go higher, you need to start speculating your targets. What is something that the market can target? Swing high. So we got a swing high here, a swing high here. Let's just mark that off for now. We got one here. We got another one up here. We got one up here. These are all clean highs, right? We got a few up here. I can mark off this one too as well, but I'm not going to mark off every single one. Hopefully you're still here with me. I'm not losing anybody. We got that momentum shift here, right? Price is going up, breaks a swing high. That could either be a false break or the unfolding of a new trend. Listen to what I'm telling you here. Only two things can occur here. Price breaks a swing high. That's either going to be a false break or that's going to be the unfolding of a new trend going higher. Fact that we got a higher swing low, that gives me confidence that the commercial speculators are going net long. We're increasing our net longs because we have a higher swing low formation. At this point, if I get any down close candle here, I'm going to look to go long and target swing highs. That's it. Let's play this price going forward. So you can see here, swing high broken. It's all good. Now we got what? A down close day. We still have some potential to get up to here. We have a down close day. What are we doing now? We're going to use a buy limit here. So we're going to buy limit. And then we're going to do what? A buy stop. Can never get this thing to click sometimes. I don't know why it does this to me. There we go. Buy stop. Trigger in on strength, trigger in on weakness. If the market is going to open tomorrow, this is the daily chart, guys. If the market's going to open tomorrow and run down, it's going to trigger me in long if I have my buy limit there. If the market is going to open and run down and then run back up, it's going to trigger me in on strength at the open. So that's what I'm using here. That's how I utilize these entry techniques. And that's how I'm blending the whole idea of reading raw price action. You play it forward. What happens after this down day? Let's drag this out. Like I said, we have potential targets up here. Now, TP and stop loss. Let's say your TP is a swing high. But what is your stop loss going to be? Your stop loss is going to be the most recent swing low that you have on the daily right here. So that's your most recent swing low. Why is this going to be your stop loss? Because if it's going to trend higher, the commercials have no willing idea of wanting to take part in running this swing low. They don't want to run this low because it should be protected. Same thing here. They don't want to run this low because the trend is unfolding higher. Let's play it out forward. See what happens. We're in the market on short, right, on weakness, and we're in the market long on strength. So we're long on both ends. Like I said, you could pick one or you could utilize both, but you need to be risking properly. Moving forward, we can see there, slowly but surely. Now we got another down day. What do you do with this down day? Same thing. You utilize it. Go long there, and you go long here. Don't overthink it. Go forward again. What happens? You're triggered into the market in both ends. What happens? Price keeps trending, 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 and there you go. That's how I would utilize that to get to what? These targets here. But it all started with what? The fact that I got the break of the swing high, a higher swing low, and I waited for a down day. Then I started utilizing it there. Now, there are times where you can catch it earlier, but if you want more confidence, this is how I would break it down. Wait for a swing high broken, wait for the higher swing low. Same thing vice versa. If price breaks a swing low, wait for a lower swing high, and then wait for an up close candle to go short. This brings me to the end of the video. I hope this video was valuable to you as a trader. If you enjoy this video, then I think you'll like these two as well. Please subscribe, like, or comment for more high quality Forex videos. As always, safe trading, leave the indicators alone, and peace.